In this week's market update, Brexit dominates the UK, Presidents Trump and Xi remain at loggerheads over trade, oil is in the spotlight after a savage price slump, and Black Friday shines a spotlight on retail. Watching events from the UK, it's been tempting over the past week to see Brexit as the most important influence on markets. It's dominated the headlines in the UK and been a big driver of volatility for both the pound and the stock market. The past week has seen big swings in sentiment. First, markets rallied after agreement was reached between the British negotiators and the EU on a 580-page withdrawal agreement designed to nail the divorce terms for the UK's departure from the Union next March. That positive sentiment evaporated almost immediately, however, when it became clear that almost no one likes the withdrawal terms. Brexiteers think it gives away too much sovereignty. Remainers think the deal is worse than staying in the EU. Most people think Theresa May has been a bad negotiator, although she has gathered praise for her dogged determination to plough on in the face of criticism from all sides. A few days of high political drama then ensued, with speculation about a leadership challenge and talk of an early election swirling around Westminster. The deal has now cleared its first hurdle by being grudgingly approved by Cabinet after a fractious 5-hour meeting last Wednesday. The next step is to get approval from the European Parliament, which should happen, and the UK Parliament, which currently looks rather less likely. Getting those stamps of approval is needed to avoid a no-deal exit and the application of basic World Trade Organization tariffs on all UK-European trade. It's generally understood that no deal would be a very bad outcome indeed for the UK economy, with grounded aircraft, queues at the ports and shortages of food and medicines all distinct possibilities. Other than getting Parliament to sign off on the deal, the only other way of avoiding no deal would be a second referendum, which the government has dismissed as a non-starter, but which is garnering increasing support from those still holding on to the belief that Brexit can be averted. Now, the market reaction to the midweek change in sentiment was pretty dramatic. As usual, the pound has been the lightning rod of changing sentiment, with $1.30 proving to be the key pivot point. Good news sends the pound above this level, market fears drive it below. In the stock market, although the internationally focused FTSE 100 index maintained its poise, the more domestic FTSE 250 saw some big falls in prices for the companies most at risk from a disorderly Brexit. These included house builders and retailers on fears for an economic slowdown, airlines and travel companies on expectations that the pound would fall further and make overseas holidays unaffordable, banks on the belief that interest rates will remain lower for longer as the UK economy slows down, and utilities, outsourcers and transport companies on worries about a radical left-wing Labour government coming to power. The falls, double-digit percentages in some cases, have left the UK market looking severely out of favour and of interest to contrarian investors, with the FTSE 100 now yielding well over 4% and valuation multiples at historic lows. The UK arguably prices in a great deal of the bad news. Previous points of domestic political crisis like this, such as the ERM crisis in the early 1990s, have been good times to get exposure to the UK market. Since September 1992, for example, the FTSE 250 has risen 8-fold. It matters a lot to people in the UK, but for much of the rest of the world, Brexit is an interesting curiosity with little or no significance to investors. Far more important for most people is the ongoing trade war between the US and China. This weekend saw Vice President Mike Pence trading verbal blows, with his counterparts in China at the APEC, that's Asia Pacific Economic Cooperation Economic Summit. For the first time ever, the meeting closed without the publication of a joint communique. Both sides are essentially posturing ahead of a crucial G20 summit at the end of November in Argentina, at which Presidents Trump and Xi are expected to meet to discuss trade. There are currently no signs that either side is blinking in a high-stakes standoff. Hanging in the balance are $250 billion of Chinese exports to America, which will see existing tariffs of 10% hike to 25% in the new year in the absence of a thawing in relations. That might just be the start of it, because President Trump has threatened to extend tariffs to the remaining $250 billion of Chinese exports to the US. The threat to global trade has started to show up in financial markets, most notably in the oil market, where recent fears that supply would undershoot demand have turned through 180 degrees. Now the consensus is that there's too much supply and not enough demand. The first scenario saw the oil price rise as high as $86 a barrel. The second has seen it plunge into the $60 range, a fall of more than 20%, meeting the definition of a bear market. The case for a supply crunch rested on a combination of a recovering global economy and US sanctions on Iran, cutting off one of the world's main producers from the global market. Fears that this could send the oil price to $100 and beyond prompted the White House to twist Saudi Arabia's arm, persuading the kingdom to crank up production. The reality has been rather different, and that extra production now looks unnecessary. Not only has global demand moderated, but supply has surged thanks to a series of waivers that have allowed countries including India and China to continue buying Iranian oil, and to burgeoning shale oil production in North America. So the outlook for the oil price is confused, but it is important. Oil is a key driver of inflation, which in turn is a key driver of interest rate policy. So where the price of crude heads next is very important. Elsewhere, in equity markets, technology was back in focus for all the wrong reasons. Apple led another tumble on Wall Street on yesterday, on fears that sales of its iPhone are flagging. Apple fell 4%, with Amazon, Facebook and Twitter all more than 5% lower. Component suppliers to Apple also suffered, as did chip makers, on fears that they could be caught up in the US-China trade war. So by the close on Monday, all the so-called FAANG stocks were in bear market territory, having fallen by at least 20% from their recent peaks. The latest tech slide helped drag the Nasdaq index 3% lower on Monday, and the S&P 500 fell 1.6% on the day. Now, looking forward to the end of this week, attention will shift from tech to retail as Thursday's Thanksgiving celebration in America morphs overnight into the first day of the Christmas selling period, so-called Black Friday. Not that Black Friday is an exclusively American phenomenon anymore. On this side of the pond too, it's expected that British shoppers will spend record amounts over the long weekend, which runs into Cyber Monday. That refers to a now rather obsolete distinction between in-store purchases, which typically happened on Black Friday, and online transactions, which waited until the Monday. Now, according to research from PwC, 3/4 of bargain hunters this coming weekend will do all of their shopping online. The average spend is expected to be over £200, and that's nearly double that as recently as 2015. The Black Friday weekend is a double-edged sword for retailers. Although it kicks off the Christmas shopping spree early, which is good news, the extreme competition between retailers means that many sales that might have been made at full price in previous years are now made at next to no margin at the beginning of the shopping season. That margin pressure adds to the already significant problems facing the retail sector, as Brexit uncertainty, sluggish wage growth and online competition have turned the high street into a bloodbath in 2018.